Welcome to CrushTheStreet.com's weekly market wrap-up. Let's get started in the equity sector, which after a week of gains, all major indexes posted losses today as fiscal cliff concerns overrode better than expected retail data and jobless claims, and of course the big one, QE4. The fact that the markets failed to move after the Federal Reserve pledged to buy Treasury-backed securities to the tune of $45 billion a month on top of the $40 billion of mortgage-backed securities suggests that no one is impressed. If we look at the technicals for the Dow Jones, the gravestone doji star that developed on Wednesday on the back of extremely supportive fundamentals was a clear warning sign that the next move will be down. Of course, this gives an opportunity for politicians on both sides to prance around and get a deal done and present themselves as saviors of the US economy. Other experts have pointed out that the fiscal cliff is a pre-contrived issue, and in the greater picture, this is merely a hiccup before we continue kicking more cans down roads that don't exist anymore. With these recent developments, one of my main concerns is that we may be entering a period where the markets, whether equities or commodities, will simply be driven by the technicals as opposed to the fundamentals. What I mean is, the market will react based on momentum traders moving in and out as opposed to logical fundamentals driving the price action. A good example would be the US dollar. When QE4 was announced on Wednesday, it was remarkably strong. Yes, it did go down in valuation, but not by a whole lot, closing at 79.82. Thursday's price action actually brought it up to 79.93. Doesn't make any sense, considering that a dilution of the money supply will be necessary to pay for the whatever back shigamajigs. In either case, the short-term technicals are very bearish, with the index below the major moving averages, and we could be seeing a challenge of the 78 level. Despite this being a technical market, the long-term picture cannot be sustained by momentum traders alone, and a consideration of precious metal bullion would be wise given the circumstances. In the meantime, the metals are admittedly taking a good-sized beating. Let's consider silver. QE4 led to a strong gain, but not nearly as much as other QEs have sparked. That was warning sign number 1. Gold hardly moved at all, which was warning sign number 2. The fact that equities in general stayed flat, with the exception of a few Japanese stocks, hint hint, was warning sign number 3. Then there was a huge sell-off in the Asian markets as fund managers grabbed a quick profit, which was your final warning before Thursday's gap down session. Silver is a perfect example of the markets going technical as opposed to fundamental. I know many of you have heard endless stories of how silver demand continues to outpace supply. I repeat, I do not doubt that story. So please don't thumb me down for that. All I'm saying is that it appears that the strong hands will keep the silver price above a reasonable threshold at $32, $30, and $26 at worst. But the momentum folks will trade the crap out of silver within its consolidation range until some level of normalcy returns to the markets. At that time, the bulls should reinvigorate the sector and we could be seeing significantly higher prices ahead. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CrushTheStreet.com.